So why at school were we learning about isosceles triangles and learning about sine, cos and tan, all those silly things that we were doing in maths? Why weren't we learning this stuff? Why do we get like to adulting and we're just like, I don't know enough about this? It just blows my mind.
Going once, going twice, sold. You're listening to The Property Pod.
All right, guys, welcome back to The Property Pod, your weekly engagement into real estate here in the Hobart Marketplace. I'm your host, Aaron Horn, and I'm joined by the team that are always here with me, Patrick Berry and John McGregor.
Always reliable, always on time.
Oh, let's not go that far.
You had to go with the on-time thing.
Yeah, I know. I knew you both would see the humour in it.
It's actually the 30th of June. I was going to say July.
I get June and July confused
it's
all
so
the
hard.
time. And in my head, I'm like, June, July, June, July.
I think it's because you've got all the other ones that are kind of alternating letters, but
Yeah,
then
why would they put two the same next to each other?
it's ridiculous. John will have some, the moon aligned at this time, and July is actually the god of thunder from somewhere.
Well, how did you know that?
I've been reading your blog. No, so it's the 30th of June, and we are kind of about to branch over into a brand new year,
Yes.
the new financial year.
Which means tax, baby.
So we know what you were listening to on Spotify this morning. Bit of Vanilla Ice to start the day.
Well, it was very icy out there. I had to do the old bucket water trick on the front of the car this morning. So
Of course. Yeah.
bit of sheen on the old windscreen. But yeah, so we came in today. We wanted to talk about tax, which is a very dangerous topic. We don't know enough about it to bestow our worldly knowledge upon the people out there. But we thought if we just brought it up, it might be a way of getting people to think about it.
Oh, think about it. Conversation started. Those type of things.
Yeah, exactly. It's kind of an awareness thing.
And we haven't had John's brother reach out for ages and tell us we stuffed something up so wrong.
So it's about
time.
I would love to feature on a Lukenomics thing where it's like people giving bad monetary advice or tax advice.
Oh, now
And-
we film and you bloody just snip it.
Yeah.
all the time.
What we've actually done is we've spoke to the fourth member of the Property Pod team, Nino. He has trawled the internet and found some really interesting information for us. And the one thing that I kind of like to, what we're talking about now is that we don't know enough about tax. Lots of people out there don't know enough about tax, and property owners who use it as an investment property, kind of, you think you're all over it, but
Yeah.
So I think the first thing we probably need to outline is that we're not experts and you should seek your own advice.
100%.
But what we thought we'd do is just bring up some questions or some thought bubbles that you might be able to discuss with your accountant to maybe find some savings or maybe get better improvements on your position.
Absolutely. And it's that obviously speaking within the realms of our expertise. And again, that goes back to something we've constantly talked about in this podcast, which is building the right team around you.
indeed.
Yeah.
Exactly.
John loves the team.
Absolutely.
We had that guy from Duotax ages ago. You brought him up earlier before, and
Yeah,
he
yeah.
came on and was really passionate about tax and really passionate about. He had so much. I was like, man, you made this sound interesting.
Yeah, exactly.
I'm not sure if we can do that today. So if
In
you,
hindsight, we should have reached back out to him.
1,000%. I can't believe we didn't think to do that. But anyway, if you're listening, we'll have you on next week, mate.
Yeah, so the whole point is just hit next and you'll actually get a good episode. Anyway, back to tax, baby.
No, so look, one of the stats that we pulled out from Nino, who's going through some stuff, is that in March 2020, the Tax Office Commissioner Chris Jordan revealed that most property investors, actually 9 out of every 10 returns were reviewed or needed to be checked off because people were just marking off the wrong stuff. So
Yeah.
it's clear out there that lots of people don't know what they're doing. So it's a fear for everybody that you get it right.
And I guess the big thing that people need to look at is, what is their rental property, for instance, in this example, made versus what have they spent on it for it to be an investment property?
Yeah.
That's really the crux of what owning an investment property is when it comes to tax, is the difference between what you make versus what you spend on it.
Yeah, quite simply. Well, it's that element. You want it to be a positive financial benefit for to your wealth, and I suppose if it's a case that if it's an investment property that's continuously hemorrhaging cash, at the end of your financial year, like, man, is this really working to my plan? Is this working to my plan? So I think the thing with the the problem with what a lot of the time happens is what it describes is that with most people claiming the wrong deductions, obviously they're not either you could say that not. They just don't know what they could claim, or they're attempting to claim the wrong thing, or they're purposefully claiming the wrong things in order to try and maximise that return at the end of the year. And obviously, in these environments, there's these points now where they're getting a lot harsher. So, in order to it's really important that you do look at the right things and do it properly, so that if you do ever get audited, you're not going to get stung in the butt down the road.
It's so tricky. Like some of these things I'm looking at, I'm just trying to make sense of myself. Like it's claiming deductions for properties that are not genuinely available for rent. So that one I don't really have to concern with, but whether you're really renting it or not renting it and kind of playing shadow games there, that one seems pretty clear. But then it's all this other stuff where it's kind of like claiming deductions for loan interest expenses when a portion of the loan was used for private purposes.
Yeah.
All this stuff is just, it goes way over my head. And then as soon as I start hearing those words about the interest that you've earned, I get so lost. So, like, I don't think I'm a silly man, but I'm not a smart man.
I know,
but I know what love is.
I know what rent is. I know what tax is.
Well, I don't. I really don't. I don't. So, like, I actually then got Nino to put together, like, what is tax, or, like, what is a tax return kind of thing. So he's given me a detailed breakdown of a tax return is a form you complete online or in paper that gets a tax agent to help, or get a tax agent to help you, of how much income you earn and how much you're claiming in deductions. Even that blows my mind.
Well, it's not, you're not alone. Like, there's so many of us, and I myself included sometimes too, where I just didn't want to do my tax return straight away, so just been putting it off because it's going to get a little bit complicated, or I don't want to ask the right questions, and it's like, oh my God, it's all now coming to you at once. Well, better get that stuff sorted, because that's part of adulting.
It is. But, all right, so why at school were we learning about isosceles triangles and learning about sine, cos and tan, all those silly things that we were doing in maths? Why weren't we learning this stuff? Why do we get like to adulting and we're just like, I don't know enough about this? It just blows my mind.
Well, that's what the property pod's for, right?
Yeah, well, it ain't helping so far. So let's try to break it down and just pick something really simple. Let's look at like our rental portfolio, and what does an investor get at the end of financial year when we sign off at the end of financial year?
Well, look, I was actually having this exact discussion with a friend of mine whose rental property that he'd owned for quite some time. Well, his primary home that he'd owned for quite a few years is going to effectively become a rental property as of the 1st of July. Now, first off, I think it is important for us to consider what it describes there, which is claiming deductions that are for properties that are not genuinely available for rent. Now, his property's been vacant for several months. However, he's been living with his partner. However, in that definition, even though the house has been vacant, it hasn't genuinely been available for rent. So though he hasn't been living there, and it's not his primary place of residence, it's still not genuinely available for rent.
So the first key takeaway there is if he's done renovation work in that 3 months, he can't claim those things back. However, if he had rented it for 12 months first and then had it vacant for a month or two before putting new tenants in and did renovation work to make it ready for the next tenant, then he probably could be able to claim some of those items back.
Yeah, absolutely. And it's that distinction, because it's going, okay, from what day did it become an investment property? And from that day, then it's now you have a new definition, and you can these things start to apply. So if you've had your house for 2 years and then it shifts into becoming a rental property, not specifically on the whatever date that is, that's when all these things start to tick over. So that's there are obviously two definitions of claims, where it's immediate and then obviously depreciation. So that's where you've got a thing that you can claim over time.
So I remember this conversation last time where he was talking about once you put the new oven in, and then eventually it depreciates into different value, but he has calculators to do.
Yeah.
Why didn't we reach out to that guy?
No, also, so what the depreciation means is that, say that oven's worth $1,000 that you bought it for, you can't claim that $1,000 as a deduction. So when we talk about a deduction, it's a deduction in your income. In the end, a rental property, if it's just on a run normally, if you've got the properties under your name, and let's just say you earn $50,000 a year from your job, and then all of a sudden you now have a rental property that you get $10,000 a year from your rent. Well, then those two incomes combined to mean now you have a total taxable income of $60,000. So what then in that $10,000 of your rental property is that what the deductions are then is you earn 10 grand, but every little expense that you incurred in order to get that now becomes a loss or a deduction.
So deductions in addition to the oven could be management fees for us to manage a property for an owner.
Yes, that's right. So
Your rates, your water bills that you pay throughout the year.
yeah, there's a whole like a list of immediate ones. So I'll just finish that like with the depreciation element is that's not an immediate deduction, but that's a deduction over time. So so with the immediate deductions, Pat, I mean the lists here they'll say the advertising costs to find a tenant. Your body corporate fees and charges. So if you are in a unit complex, your council rates, your water charges, your land tax, any cleaning expenses during the course of that year as well. Your gardening and lawn mowing. So that's the consistent presentation. Pest control if needed. There's another instances your insurances. So both your building, your contents, your public liability, your landlord's policy. The other element is interest expenses. So interest expenses is that on if you've got a loan to buy that property and there's obviously interest on that loan, you've got the interest is what's the proportion that's deductible, not just the whole mortgage itself. Just
So I'm not getting the house for free is what you're saying.
exactly.
Damn it.
Yeah.
No, but see, like as you're reeling all those things off, it's just like making a pile in my head of just being like, this is crazy. Like there's no way I could keep on top of this.
And this is where maybe hiring a property manager to look after the property comes in handy. So, for instance, with our agency, we offer to our owners they can choose to pay these bills themselves, or we can pay it on behalf of them if they want to.
Yep.
And the reason we do that is so at end of financial year they get a end of financial year report that has all of these deductions listed in one spot.
Absolutely. And that's and that's something we discussed with my friend as well. And this obviously something that I set up as well is with the company looking after my property. Well, everything just flows through the business because every expense, and that's what it further goes in description is that you do have to have it documented, and you really need to have those invoices so it can be matched back to the dollar. And
So for someone like you, John, who's constantly losing things,
Yep.
you don't want to keep receipts for your land tax and your water bills and all that and keep track of them for the end of financial year. We do it for you basically.
100%.
So later today when Abby does the close off for the end of financial year for our rental portfolio of all our properties, all our owners will get a document which is called an end of financial year report, and it'll show every bit of rent that came in and every expense that went back out, and then a net total at the end. And so that's one piece of paper that our owners have to hand to their accountant.
Yep.
And that's all they have to hand to the accountant for the rental property if we have paid for everything throughout that year. If John had chosen to pay the bills himself, they'd still get that report, but then he'd have to go find all of the other documents and gather them all up to get to the accountant. So a lot of our owners have discovered over the last couple of years it's in their best interest for us to pay everything for them so that nothing is forgotten about come tax time.
Yeah, I guess that's one of those tricky ones because I was just thinking before, like around this time of year, I get really excited, and then when I'm, thinking about tax and it's in the forefront of my mind, I'll be keeping those receipts and being like, oh, I'm going to take a photo of all of these and put them in my email, and then I'll never lose them, or I'll put them in here.
Yeah.
After about a month, it all just falls apart, and you just go back to living your everyday life. Admittedly, I don't have investments, I don't have investment property, so it's not something that I think of. If that's something that you're really into, I'm sure people out there would be doing it. However, it sounds way easier the way Pat's describing. The property management team manage everything, and then at the end of it, here's your form, go and
Forward it on,
and we'll go from there.
Done. Exactly. And that's why then, it's with two buttons, all of a sudden, 90% of your work associated with your property for tax is finished. And that's where all those, you'll see all those immediate deductions, come through that statement that the accountants go, yep, done.
Cool. And like some of our owners, they're lucky enough to have 3 or 4, and some have got even 7 or 8 properties with us.
Yeah.
Imagine trying to keep all of that paperwork for 8 properties individually yourself. It'd be just a nightmare to keep track of it all.
And look, and some people like it, but I don't know why. And I suppose, it's that element too where you will find those people that are thinking, well, if I do it myself, maybe there's other elements that, I can claim, or maybe I can do. And this is the thing too where, some people might do cash work for repairs versus actual,
Not that we condone
not
cash
that we
work,
condone it,
ATO.
but yeah, exactly.
But through without it being invoiced
Yeah,
back
exactly.
to you. It's just,
And-
I'll do
or,
the
or, they
cashy.
might, or they'll just say, look, well, the owner might organise the maintenance without us, and then they'll just pay the invoice direct. And then, like you described, or rather than having that funneled through the rental income to us, like they've still paid it regardless, but now they've just got to keep all those additional records that otherwise could have been collated nice and easily. And that's where obviously professional management can have a huge.
And what a lot of owners also don't remember as well is not only do they have to keep them for end of financial year purposes, but when they go to sell the house in 4, 5, 10 years' times, because they will have capital gains tax, which is a whole other thing that they need to worry about.
Yep.
But everything they've spent on the property during the whole time they've owned it can help minimise that tax when you do go to sell the property. So I think the more that you can run through the one location,
The better.
the better.
Yeah.
That way it's just a nice clean record of the entire history of the property from the day you made it a rental to the day that you decided to sell
to
the
let it
property.
go, yeah. And I suppose that, sorry, flag that, brings us to that next minute, like that one where we had the gentleman on before about the
Twan. I went and looked it up.
Oh, you did? Oh,
Yeah.
perfect.
Twan from Duotax in Melbourne. Yeah, he was a champion.
Yeah, he was great, and that's where I suppose the quantity surveys are really useful, because now if we've covered off a few elements that you can claim immediately, like another one's repairs and maintenance, for example. So then it's okay with larger capital works. So that is when if you do a renovation, or new kitchen, or you've had to replace the guttering, which is going to cost several $1,000s, you can't claim all that in one hit.
What do you mean by? Well, what does that mean?
So let's just say that you had to do a capital works, which is a large change to the property, which is guttering, for example.
Yeah, you just said that.
Oh, I said the exact same thing.
Exact same example.
Just flag it because I've got it here. So
Sorry.
I like it. Just leave
thanks,
it.
man.
You just said the same thing,
I
and
said
I
the
was
exact
like,
same thing.
it was like someone would think this is on repeat because it's just gone and then the gutters.
Yeah, and then the gutters. Okay, so it's defined as capital works used to produce income, including buildings and structural improvements, are written off over a longer period than other depreciating assets. So what the capital works is, you're required to do this work in order to maintain
That the house is-
an income producing asset.
Yep.
Because if the house doesn't have gutters anymore, you can't use it as a income producing asset. No one can stay there. So you're continuously investing in these capital works in order for it to be of a quality, so it can stay a rental property. Yeah. So
I tried so hard. I was still listening.
you could just you get rid of capital works and just put maintenance and repairs.
Cool.
But that's not just you're not replacing a PowerPoint. We're replacing a deck. We're replacing kitchens. We're replacing huge capital, huge monetary expenses.
But didn't you say you can't use that all and write that off in one
Yes.
big go?
Yeah. So-
what do you mean by that?
So
That's where
that's-
I got lost.
Yeah, okay, gotcha. So now what they're talking about is, let's just take, for example, you've had to do a big repair to the kitchen. It cost you $5,000.
Yep.
So if in the instance of a maintenance repair, like you could claim instantly, let's just say you had to replace a PowerPoint, that was $300. You can claim that whole $300.
Is that how much PowerPoints are?
I don't know. And you might not
I don't
be
know.
able-
I'm just asking. That,
Yeah.
that's expensive.
Aaron, we're getting off track. John's trying to teach you,
But just-
and you're being.
But just even your insurance policy, your landlord's policy, which might cost you $400, you can claim that $400 that year. Okay, so that's an instant one. But a depreciating one with that kitchen example at $5,000, it's worth $500 to repair. But each year, like the quantity surveyor will say that it reduces in value over time. So this
the
year
kitchen isn't worth 5,000 next year; it's worth potentially 4,000.
Yeah.
Yeah.
So you can claim so much year one, so much year two, so much year three, and for so many years,
Yeah.
you can
Yeah.
claim a little bit each year off the total amount.
Yep. So therefore, you're not. So
No, yeah, I think this is exactly what happened last time we talked tax. I just
You got stuck.
brain exploded, and I was just like, I'll just keep pressing the buttons.
So I guess that's the thing. So when you're coming into like the key takeaways are, as you move into the new financial year, maybe you could look at a couple of ways of making it easy for you the next year. So first off is obviously getting all those expenses, if you do have professional management, through the one funnel.
Yep.
So it comes out the end.
Love that.
And then next, speak to a quantity surveyor and have that the depreciation schedule organised. It will cost you a bit of money to do, but then obviously there's going to be a lot more opportunities for you financially than otherwise that you may not have known.
Yep.
And key takeaway number 3, probably find a podcast that actually knows what they're talking about.
I don't know why I was like, tax time's coming around, let's talk tax. And then I was actually lying in bed last night thinking like, why did I think this was a good idea again? It's like the first time we did the show, we did it about the federal election. Like, hey, let's choose the hardest way to start a podcast.
Yes.
Look, I think the key thing that John has pointed on is that you need to have your team and you need to go seek some advice from your team. All that we're suggesting here today is that have some conversations around it and find out to make sure you are getting the most out of what you can claim.
Yep.
And that's the thing is that, you know, good advice is cheap.
Yep. But,
You know?
I think this is the perfect point to pivot to something that's not on Aaron's notes.
What's that?
I think we should be talking about Dry July.
Oh, yeah.
Something we actually know what we're talking about.
Well, yeah, you guys definitely know about drinking, and you definitely know that for the next month you won't be doing it. So I'm not doing it either. I am doing Dry July. I will not be drinking for the month of July.
Yeah, so we've actually got a team going this year. I think your dad's on it, John.
Yeah, I don't know if he's ever done.
Well, he's by far killing the rest of us on sponsorship money. So obviously no one else believes that he can do it because everyone thinks it's funny and everybody donating like crazy to him.
Yeah.
So it'd be interesting to see if your old man can last 30 days. It's a
He
very
will.
long time.
Once he sets his mind to something, there'll be a challenge. But I'm confident he'll do
Yeah,
it.
so we've got Chris, Martin, Aaron, Abby and myself so far on the team. So looking to try raise some money for Dry July. over the
Yeah,
next
look,
30 days.
it's an amazing cause. It's for cancer awareness out there. I know lots of people, or a majority of Australians, I'm sure we could find a stat that would say the majority of Australians know of or have been affected by cancer. We're kind of battling some stuff like that in the family at the moment. So it's definitely a cause that's close to a lot of our hearts. We're raising some money and awareness for Dry July. Might sound like a funny idea to be like, oh, we're not drinking, but it's definitely a really interesting cause.
Yeah.
414 getting behind it.
And anyone that knows real estate agents know that we drink a lot. So it's a stressful type of industry to be a part of, and sometimes that helps. We're going to try as a team to stay together.
Yeah, and that's why I do like the Dry July element, because it really is, you know, a cause that it's almost breaking a habit. You know, it could be you're seeking alcohol for enjoyment, or you're trying to relax, and then or any myriad of the 100 different ways and why you turn to it. But that's it. Like that 30 days will help break a habit if you've been struggling with it in the past as well. So I think it's a really good cause in that sense.
30 days is a long time. I told Martin I'd never do it again when I did last time with him, but here I am. So
I think the longest I've done is 6 months as an adult.
wow,
Yeah.
impressive, John.
So it can be done. All of a sudden you'll find your skin will look better. You know, that happened to me. Your wallet's fatter, and all those things. Of course, once it ends,
It goes back to normal.
good luck.
I'd love to see if in a few weeks' time, once the podcast is kind of mid-July, whether you're kind of just got the shakes or anything's
DT.
happening. The DTs. No, you don't drink that much. No, look, it's a really good cause. We're really behind it. We might be pumping it up through the podcast, and if you can donate, that'd be really great. We'll be donating $100 of every sale made in July.
That's correct.
Is that
Every
true?
sale that we do over the next month, we're going to be putting $100 towards the team funding as well to
Yep.
try boost that up.
Yep.
And we'll see how far we can get this number.
No, I really like that. I think that's a really good idea. Shout out to everybody out there that is joining Dry July. If you'd like to join along with us, that would be great as well. Something we're doing here. Thank you for getting through to this part of the episode, because, man, that was a slog. Next time I come to you guys with the idea of, hey, guys, let's talk tax on the property pod.
Well,
Just shake me.
That's the thing, is that when we actually have this,
What are you doing, man?
the coffee table conversation with the clients is quite short, because it's it's 3 things and let's go speak to your accountant.
Yep. No, look, reach out to your accountant, keep all your things in order, and if you need, get a property manager. They'll definitely help you out.
Right.
Thanks for popping the notes together, Nino, and thanks for listening to the Property Pod.
you guys.
Share, subscribe, all of that stuff.
See you, Kay.
Bye. You have been listening to the Property Pod, recorded and edited by 414 Media House in conjunction with 414 Property Code.
This podcast is general information only, and the thoughts and views expressed is the opinion of our panel, and listeners should always seek then use their own investigation into any topic we discuss to ensure they fully understand their own situation.
It does not constitute and should not be relied on as purchasing, selling, financial or investment advice or recommendations, express or implied, and it should not be used as an invitation to take up any agent or investment services. No investment decision or activity should be undertaken on the basis of this information without first seeking qualified and professional advice.